Bitcoin's price is doing something it hasn't done in a while, and almost everyone is looking at the wrong charts. While day traders are glued to the hourly candles, drawing lines, and trying to guess the next 3% move, the real story is unfolding in regulatory debates that will define not just the rest of 2026, but the next decade of crypto. There's a dangerous disconnect between the choppy price you see on the screen and the seismic shifts happening behind the scenes. This gap means most investors could be completely blindsided by the next major market move. And that move won't be driven by traders, but by a tidal wave of institutional money that's been waiting for one thing: clear rules. Today, we're connecting the dots. We'll look at the confusing price action, dive into the landmark regulations being finalized right now, and show you why the volatility you're seeing isn't just noise. It's the market holding its breath. First, let's look at the chart, because it's telling a story of profound indecision. As of mid-March 2026, Bitcoin has been volatile but trapped. After the incredible run to its all-time high of over $126,000 back in late 2025, the market has been in a corrective phase. We've seen prices hover in the low 70,000s, showing flashes of strength, but failing to break out decisively. This isn't a clean breakout or a decisive crash, it's a battleground. On one hand, some technical analysts are pointing to bearish patterns, suggesting a risk of a significant correction if key support levels fail. The critical level many are watching is around $62,300. A break below that could trigger a much deeper slide. On-chain data also shows that many recent buyers are currently at a loss, which could suppress demand. But here's where it gets complicated. While some chart signals are flashing warning signs, the underlying flow of money is telling a different story. Whale accumulation has been noted, and ETF outflows seem to be easing, suggesting big players are buying the dips and flushing out weaker hands. The Fear and Greed Index has recently dipped to levels of extreme fear, which historically can be a contrarian signal for accumulation, not panic selling. So you have a conflict. The charts look heavy, suggesting a potential drop. But the underlying flow of money, with institutions buying dips, suggests strength. This choppy, overlapping price action isn't a clear trend. It's the market coiling like a spring, full of tension. And that tension isn't just coming from traders. It's coming from Washington, D.C. While we've all been watching the price chop around, the very foundation of the US crypto market is being rebuilt. 2026 is the year regulation moves from talk to action, and one piece of legislation is at the heart of it all. The bill you need to be watching is the Financial Innovation and Technology for the 21st Century Act, better known as FI21. This isn't some minor proposal. It passed the House of Representatives with strong bipartisan support back in May 2024. So what does FIT21 do? In simple terms, it finally aims to answer the question that has plagued crypto for a decade. What is a security and what is a commodity? The bill gives the Commodity Futures Trading Commission, CFTC, clear authority over digital commodities, like Bitcoin, and leaves the Securities and Exchange Commission, SEC, in charge of digital securities. This is the clarity the industry has been begging for. But here's the holdup. The bill has been stalled in the Senate. A major sticking point has been a debate over whether stablecoins should be allowed to offer yield, which has pitted traditional banks against crypto companies. But make no mistake, the pressure to pass this bill is immense. It's seen as essential for the US to remain competitive and provide clear consumer protections. This isn't just a US story either. With regions like Europe, Hong Kong, and Brazil rolling out their own crypto frameworks, the entire developed world is moving in the same direction, from ambiguity to adoption. This is the kind of analysis that separates reacting to the market from understanding it. The headlines will only tell you the price. We tell you the why. If you want to stay ahead of these monumental policy shifts and understand what they mean for your portfolio before they happen, make sure you subscribe to the channel and hit that notification bell. We filter out the noise so you can focus on the signal. So, how do we connect that messy price chart with this landmark regulation? This is the key. The tense, volatile price action you're seeing is not random. It is the signature of an institutional market pricing in complex regulatory outcomes. Think of it this way. The success of the spot Bitcoin ETFs is the new floor. The fact that trillions of dollars in capital can now access Bitcoin through registered, regulated products provides a massive, concrete layer of legitimacy. That's why every dip gets bought. That's why, despite bearish chart talk, we haven't fallen off a cliff. The institutional foundation has been laid. FIT21, however, represents the ceiling of uncertainty. That anxiety on the chart? That's the market's frustration about the bill stalling in the Senate. The resistance isn't just a technical level, it's a policy resistance level. The market seems hesitant to break out to new all-time highs until it knows the final rules of the game. The volatility is the sound of the market pricing and probabilities. Every rumor of a compromise on FIT21 causes a spike. Every headline about a delay causes a dip. This isn't a retail-driven market anymore. This is a market driven by compliance desks and institutional strategists. According to a recent survey from Coinbase and the EY Parthenon team, 78% of institutional investors say clear market structure rules are essential for further development. They aren't just waiting for a price signal, they are waiting for a legal one. The current price action isn't just about Bitcoin the asset, it's about Bitcoin the regulated asset. That transition is happening right now, and the chart is simply showing the footprints. What does this mean for you? It means you have to fundamentally change how you view this market. The days of simply riding four-year cycles are evolving. The game is changing from a purely speculative bet to a strategic allocation in an emerging and soon-to-be regulated asset class. First, the institutional wave is no longer a meme. It's a reality being written into law and market structure. One 2026 survey showed that nearly 3/4 of institutional investors plan to increase their crypto allocations. Another noted that 86% of institutions already hold or intend to hold digital assets. These are not small numbers. Second, the passage of a bill like FIT21 would be one of the single most de-risking events in Bitcoin's history. For years, the number one reason institutions cited for staying out of crypto was regulatory uncertainty. That excuse is about to be wiped off the board. Once Bitcoin is formally and legally defined as a commodity under CFTC jurisdiction, the floodgates for more conservative pension funds, endowments, and corporate treasuries could open. This means that the long-term bullish case for Bitcoin has never been stronger, even as the short-term chart looks confusing. The infrastructure for a multi-trillion-dollar market is being built before our eyes. While short-term traders are getting shaken out by 5% swings, a new, more stable foundation is being poured. So, while the crowd obsesses over the daily price swings, you now know the real story. The critical news isn't a price target or a new indicator. It's that the legal and financial architecture for Bitcoin's next era is being finalized in Washington. The indecisive price action is the sound of a market holding its breath, waiting for that final green light. The spot ETFs already built the on-ramps. A clear regulatory framework like FIT21 is the final traffic signal. Don't be distracted by the noise. Pay attention to the signal. The next major catalyst for Bitcoin won't be found on a trading chart. It will be found in the halls of the US Senate. Watch the developments around the FIT21 bill. Because when that signal finally turns green, this market probably won't be quiet for much longer.